Hello, everybody. Welcome to my lecture slash overview for intermediate accounting. This is Wiley Chapter 4. This is the balance sheet and the statement of cash flows. Okay, so my disclaimer and copyright notice: the information and opinions in this presentation are those of the author only and not the author's employers or affiliated organizations, including but not limited to Irvine Valley College, the South Orange County Community College District, or California State University at Fullerton. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. The questions that are shown in this presentation are copyright 2022 by Wiley. The questions are from the 18th edition of Intermediate Accounting by authors Don Cuso, Jerry Weingut, and Terry Warfield. This presentation is copyright 2008 to 2022 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. So one of the things that I want to kind of share with you is about like this video series is I'm not using Wiley's prepared PowerPoint slides. I'm really going to go talk about more about publicly traded companies and to kind of go through and show you kind of some of like the little differences between what Wiley is asking in questions and what we're going to be showing here today. I would also, before going through and looking at the problem walkthroughs, just to get better context or before approaching the material, this is a great video to watch. And again, to remind all of you, the more time I spend on this, I'm going to be better off. Right. So that's really what we kind of want to know. The more time I spend viewing publicly traded companies, the better off I'm going to be. Now, what I want to do is, because this chapter, which is chapter 4 of the 18th edition, it used to be chapter 5 of the 17th edition. What we're kind of doing is the first exam that I typically give is essentially to make sure that a student knows how to go through. And thank you, Miss Lacey Willis over at Chapman University. This is really a video to go, or the first exam is really to make sure that you know, did you get the base knowledge of debits and credits from financial accounting. The next exam is typically showing, you know, we already did the video on the income statement, talked about discontinued operations, but this particular chapter is we're talking about some balance sheet concepts and also the statement of cash flows. We're introducing it, and I'm going to show you also too where it shows up again. Present value concepts, and then revenue recognition. Now, you might be saying, well, wait a second, why are we jumping ahead to revenue recognition? And again, I've seen this where a lot of accounting instructors kind of say, well, it makes more sense to have it with the topics that we're kind of, it relates more to this part here with the income statement. So it's a better place to put it in terms of exams or of coverage. So this next part over here, chapters 6, 7, and 8, cash and AR, inventory costing. So we're kind of working down the balance sheet. And what you'll notice here for this last part is we're going to be talking about property, plant, and equipment, not personal protective equipment, depreciation and impairments, intangibles, and investments, right? So investments also kinds of skips ahead a little bit. But then we get over here to the other part of it, which is looking at the back end. The reason why I'm showing you this is that if you take a look at chapter 22, you're also going to go through and see the cash flows again. So the real purpose of introducing the cash flows here is that it is a very important statement, and I'll be showing you why momentarily. But when you see this balance sheet and cash flows, it's really to give you a little bit more of an overview than anything else. So today we're going to be looking at a few different publicly traded companies, including Apple, Lowe's, Disney. We're going to look at Twitter's 10K from a few years ago when we're talking about cash flows. And we're going to look at also Meta Platforms and kind of the justification behind why I'm going to be kind of talking about some of the topics I'm talking about. I think Meta Platforms is being extremely progressive from a financial statement standpoint. Okay, so how does a balance sheet structured? Okay, so you're going to see a company name. And this is the way that I like to do it, right? You're going to see a company name, balance sheet, and it's going to say either as of or 12/31XX or whatever the year, whatever the period end is, right? It's going to be a specific date, because for the balance sheet, unlike the statement of cash flows, unlike the statement of retained earnings, unlike the income statement, we're taking a photo. right? What were our assets, liabilities, equity? What were all those balances at a certain point in time? Okay, so when we're looking at assets, the main when we go through and look at these publicly traded companies, the one thing you'll notice is you'll see that each one of them is going to show current assets and current liabilities, right? And then right below here, you're going to have non-current assets, non-current liabilities, maybe total assets, total liabilities. And then lastly, you'll have owner's equity. And then we have to show our total liabilities plus our owner's equity. Now, what's really kind of crazy is that when an instructor teaches financial accounting, there's more than one way to do things, right? When I go through and look at this, I'm going to teach you a certain way to do things, but you're going to see it's management. These are management's financial statements, and they're essentially going through and choosing the way they want to set this up. But however, the one thing you will see is that you have to show current assets and current liabilities. Let's go over here first to my favorite example. And so this is going to be, as we go over here and look, this is going to be Apple. Okay. And by the way, I am making this on a Mac Mini. So if Apple wants to send me some really cool stuff and I can give them plugs all day, why not? For the accounting professor, sounds great. Talk about myself like a third person. Okay. So let's go ahead and take a look at Apple. This is their annual report. As I come down over here to financial statements and supplemental data, right? That's their income statement, comprehensive income. And now we're getting to the balance sheet. So what you're going to notice here is that typically you're going to see assets they should be ordered in liquidity, right? So you're going to see current and non-current and then total assets. Now with cash, it's obviously going to be the most liquid. By definition, I believe it has to be able to be converted into cash within 90 days. That's why we call it an equivalent. Marketable securities, when we get to chapter 6, I'll talk a little bit more about that. Marketable securities, accounts receivable, right? Why are accounts receivable more liquid than inventories? Because for accounts receivable, we've already sold or provided the services. We have not yet converted the inventory into a sale. Then you see over here, vendor non-trade receivables, other current assets, right? So we're generally going to be doing this in order of liquidity. So over here for non-current assets, you've got marketable securities. Property, plant, and equipment, this is generally always going to be non-current. There is an exception to it if we're actually holding the asset for sale, but that's not here today. So again, current versus non-current assets, and these classifications are extremely important to investors. Why are these so important to investors? Is because when an investor goes through and they're trying to basically see, well, do I have the coverage? Does this company have the coverage to meet its obligations? This is what they're going to be going through and doing. They're going to be using things like the quick ratio, the current ratio, those kinds of things, more like the quick, to make sure that a company has an ability to repay its obligations. Okay, coming down over here to liabilities, right? Again, order of liquidity. Current means, and by the way, what does a current asset mean? It means we're going to be using it within the year. Current liabilities, it's basically we're also going to have to settle this within the year. What does this mean? Well, my deferred revenue is that revenue that I have to basically or those obligations I have to satisfy in the coming year. You've got commercial paper, term debt. So this is how we see it on liabilities. Again, current being paid within a year. Non-current liabilities, you basically go through in here, see what does that mean? It's basically beyond a year. Now, one of the reasons why I'm going to actually want to point this out to you now is that you'll see oftentimes, you'll see Wiley do this, and it's not incorrect, but they'll use the term, and this is their problem 4-5. They'll use the term long term, right? In my mind, if the SEC rules are saying you have to show current and then everything else, I don't like using the terminology of long term. Why is it? Because in the mind of an investor, that could be 5 years from now. But if I say non-current, it's pretty much encompasses everything that's not a current asset or liability. So most disclosure you'll go through and see with companies they'll be going through and they'll be showing like non-current assets, non-current liabilities. I think it's better legal disclosure. By the way, too, if an investor, right, sees long term, and the liability is due on day 366, well, it's long term, but and again, you just could get into that argument. And that's why I've seen most companies will show things, if they do show non-current, they'll just basically show current, and then they'll show those items going through below. Okay, commitments and contingencies, and then you have shareholders' equity. With shareholders' equity, we really don't see the separation that we do with assets and liabilities. And really, there's no really reason to. It's basically what the owners, the remaining owners, what the owners own of the company after the liabilities are settled. Okay, so that's our first example, is Apple. So next example over here is going to be Lowe's. Just pulled up their quarterly report. Why did I choose Lowe's? Because I guess, well, I've had enough fun with the Home Depot, so let's try something else. Now, what you'll notice here about Lowe's just shows current assets, and then they dump everything else out, right? So they show current assets, and then they're showing property, operating right of use, long-term investments, and I probably would change that, deferring, but you see, again, they still do it. So again, it just depends on who the corporate counsel is. I would probably say over here, it's better just to say, because they're not saying non-current, they're having to show this over here is long-term. Now, by the way, if you're the CFO or the head of financial reporting at Lowe's, feel free. This is just friendly criticism from your friendly neighborhood accounting professor. Just violated something in the MCU, but it's owned by Sony, so we're okay. So when we were looking at this, that's why I would use a designation of non-current. I think it's cleaner, right? Because then it tells the investor, well, you've got about 22 billion of current assets. You've got total assets of 46 billion. So you're going to have about 24 billion of non-current assets. Okay. So coming down over here, again, long-term debt excluding current maturities, non-current operating lease liabilities. So they're kind of blending it. We'd have to probably look at the footnotes and see why they're doing it that way. Deferred revenue, and then other liabilities, and then total liabilities. So their liabilities are exceeding their assets, right? And what this also kind of tells us too, is that when we go through and look at this, well, they've got current liabilities of 20 billion against current assets of 22 billion, but some of these down over here, we're going to be a little bit more concerned about. Okay, so again, when we're looking at classifications here, we've got current, and we're not showing anything for non-current. So this is really how Lowe's is going through and showing it. Just to kind of wrap things up here with Lowe's, they've also have right over here, they've got their common stock, and so their equity looks relatively the same, but they had a pretty huge deficit that came through. So it'll be interesting to go through and take a look in terms of what caused that. Okay, but not today. So going over here to Disney, let's take a look at Disney. And this is really why it's so important for you as an accountant. You want to be going through and you want to be looking at these publicly traded companies. The more time you spend, trust me, when you start your job, if you're going to be working as an auditor, it's only going to put you in a better position to succeed. Okay, so for Disney, current assets, right? So we're kind of seeing the same thing, produced and licensed content costs, investments. Now, why aren't they saying long-term or non-current investments? I don't know. So you've got over here, parks, resorts, and other property, projects in process, land, intangible assets, goodwill, other assets, total assets. So they're not, its current is 31 billion. Non-current is about 173 billion. So again, they're choosing not to do that. Now, this is what's really interesting about Disney. If we look at Lowe's is going to show us current liabilities and then total liabilities. And this is something where I'm a huge Disney fan. But if I look at this over here, what Disney does is they're showing current liabilities. Then they show borrowings, deferred income taxes, other long-term liabilities, redeemable non-controlling interests, and then they're getting into equity. And they don't show total liabilities, right? So, and they have equity here of 96 billion. Now we could infer that if their equity is 96 billion, that their total liabilities are 100 and what would that be? 110 or 106, 114, 118 billion, something like that. So why Disney is choosing not to do it. I mean, but look, Disney has the best financial reporting people in the industry. So if they're doing it this way, I'm sure the SEC has bought off on it, but that's what they're doing now. I just, for myself, and this is again, I like to see like Apple. I want to see current assets, non-current assets, current liabilities, non-current liabilities. To me, it's better. And that's what I like to teach my students. So again, and when you're seeing this over here, so with the takeaways in terms of the balance sheet, you're showing this in order of liquidity. Remember, receivables will be more liquid than inventories because receivables have already either I've performed the service or delivered the goods, or I've sold the inventory. So that's for the Disney company, right? So that's our third example. Okay, so our next one over here is going to be looking at Twitter as well as Meta platforms. And I'll make sure that I basically go through and post these through. So when we're looking at the statement of cash flows, right? So when we're looking at the statement of cash flows, why are cash flows so important? And what exactly does cash flows do? Well, if I come over here to the Walt Disney Company and we look at their statement of cash flows, we're taking their net income and then we're making some certain add backs. And we're adding back some non-cash type items, basically depreciation and amortization, other changes to the operating assets and liabilities. And then we're looking at cash flows, meaning that how is the company getting their money? Are they generating their funds from operations? Are they generating it by selling stock or selling equity instruments, or selling debt instruments? Are they investing their money? So the statement of cash flows is by far one of the most important statements to an investor. Because if we see a large cash balance, well, that's great, but did we borrow the money? Did we sell stock, or was it generated from our operations? So the statement of cash flows is extremely important. Now, for those of you who have not gone through and have really spent the time on cash flows from financial accounting, this is your time to go through and to do it. The way that I teach this, from a mechanical standpoint, and I really want to encourage you to learn how to do a statement of cash flows. I'll never forget, I was interviewing for a job as a CFO, and the person at the firm said, well, we want you to do a cash flows for us. It's like, okay. And I think he really regretted it because I started teaching it to him and he didn't like that. But in any event, when we're looking at cash flows, when we look at this, the way we're going to set it up, and again, I have solution walkthroughs for this, but our first step is going to be, well, did cash go up or down? Now, in this Wiley question, it went from 22 to 73,000. So cash went up by 51,000, right? The next part over here, when we're dealing with cash flows from a mechanical standpoint, is then to say, okay, let's make the skeleton, right? Operating, investing, financing activities. Next step is to set up T accounts, right? We go through, we create, and trust me, this is by far the best way to do this so that you understand it, right? So over here, you put in all the balances into the T accounts, the opening and closing, just like right over here. Oh, accounts receivable is 82 and it's 66, started with 66, ended at 82. Then you go through, you deal with the additional information first. And then you go through and you look and basically make sure that we balance out the accounts. This is something I did in my class last night. So for AR, how do we get from 66 to 82? Well, I needed a debit of 16. I do the opposite to cash, or I credit cash. And this is basically, what is it? It's an increase in accounts receivable. If this seems foreign to you, it's okay. You want to spend the time, though, learning the mechanics of how to go through and to do a cash flow. It is well worth your time, because guess what? When you get to chapter 22, at the very end, it's going to be a whole nother process for you to go through and learn. I generally do not teach the direct method because my understanding is I think you still have to have the indirect as a supplemental schedule. But again, The direct method, I cover that in my chapter 23 or 22 videos. You can find them out there. But I would really strongly encourage you that, you learn how to do a statement of cash flows. Spend the time, use the T accounts. You'll be a much happier accountant. Okay. So, but why are these so that's the mechanical side. But now let's take a look over here as why are we introducing these now, or why is Wiley introducing them now? And I completely agree with the way Wiley is doing this. It's because we're essentially rounding out, we did the income statement in 3. We just talked about the balance sheet, right? This B/S does not mean, it means balance sheet. One of the most, it's by far for investors, and kind of going back and seeing why is it so important. It's because there is so many there can be so many different type of accounting adjustments that may not make sense from an investor's point of view. Now, the example I'm going to start you with is going to be with Twitter. And when I look coming over here, and if I go through and look at Twitter, let's go to their financials. Perfect. Okay. So Twitter, oh my God, they lost $108 million. They lost $456 million. They lost 521. And we say, oh my goodness, wow, this looks awful. This is like terrible, bad day. But is it really that bad? And what we need to do is we need to go through and look at, well, what are non-cash expenses that are going to impact the income statement, and how can we find them? What's going to help us go through and find them is going to be the statement of cash flows. Now, when it comes to, this is a link that I'm going to put you to, that I'm not really looking at adding back depreciation and amortization, because per Munger, Charlie Munger actually said this really well. EBITDA may not be the best way to look at it, because, depreciation, you got to basically reload your equipment or your buildings. So again, it just depends on the business. But why are these non-cash charges, and why are they going to be added back to the statement of cash flows? And what you're going to see here is, oh, depreciation expense, I'm adding this back into my net income to get to my cash provided by financing activities. Why am I adding back depreciation expense to net income to get to net cash provided by operating activities? Well, the reason why I'm going through and doing it is because it's a non-cash expense. What do I mean by that? Well, when we look at this over here, the way I record depreciation expense is I'm debiting depreciation expense, and I'm crediting accumulated depreciation, which is a way I have of accumulating the expense I take over multiple periods. Same thing with amortization expense, right? Intangibles, debit amortization expense. Amortization expense is used for patents, trademarks. Remember, with goodwill, we do not amortize it, we impair it, right? So these are non-cash expenses, and on the cash flows, they're going to be showing through and adding them back. Now, this isn't the one that I have the problem with. The bigger one I have the problem with is with stock compensation expense. Why? And I'm just going to be very brief here. It's because when you give options under the accounting rules, it doesn't really cost the company anything depending on how the option is structured, right? But what it does cost is you're going to give those employees potential shares. But if you have an interest in this, I want you to take a look, and I'll copy this playlist down below once I go through and publish this video. But is it a real expense? And to me, stock compensation expense, it's really, to me, it's not. There is a cost, but again, I'm not crediting a liability. I'm crediting a part of owner's equity. So, and is this a big deal for companies? Well, I think so, because if we go back to Twitter, and if I look at Twitter over here, right? If I add back the stock compensation expense, which, by the way, where did I find it? Oh, if I come over here to the cash flows, got depreciation and amortization. We're not dealing with that, but we're dealing over here with stock-based compensation expense. If I add that back to the net loss, oh, all of a sudden things look amazing, right? I'm now at a net income, a positive amount of 325, 161, and 161. And again, this is why a lot of companies will choose to use non-GAAP financial measures when they're going through and doing their earnings calls. They're going to say, oh, well, on a GAAP, we lost this. On a non-GAAP, we did this. So, okay. So that's really the importance of the cash flow. It's not, it's because it tells us, it can tell an investor, how did the company get hit with different things? And this one's a big one because to me, what you're really effectively doing is you're increasing the additional paid-in capital of a company right over here by looking at this and saying, oh, stock-based compensation, this increased my, basically my additional paid-in capital by these amounts over here, right? This was not a fundraising, this is not a public fund offering. Right, this is over here. This was issuing stock to shareholders. So, excuse me, issuing options to my employees. So this has a huge impact on companies, and that's why the statement of cash flows can really help an investor. And this is again, when we look at the tree, the theoretical decision tree, or the what is our overall objective for financial reporting. It's to go through and to essentially give investors the best information to go through and to make a decision. And so the statement of cash flows can help an investor say, well, is this really in that loss? Or are there some accounting shenanigans? And they're not shenanigans, right? The rules of accounting, I don't agree with this one. I would rather have a capitalization table shown at the very beginning. But again, I heard that from an investor about 12 or 13 years ago, and that investor was absolutely correct. I want to see a cap table. I want to see how am I going to be diluted. This stuff here to me is just absolute garbage. So when we come over here, I would still do it though. If I'm a CFO, I'm still going to go through and report it. I'm not going to not record stock compensation expense because the last thing I want to do is violate SEC's law. I'm just saying I don't agree with it. Okay. Now for the future, and I'll share with you this video playlist I did. I did a project for my intermediate accounting students at Fullerton last spring. Great project. And what I did was I chose some high level publicly traded companies that had a lot of stock compensation expense. And when we look at companies like, and this is Meta Platforms, right? So when we look at Meta Platforms, what's very interesting is when we take a look at them, what you're going to notice about Meta is that, well, they had net income of 6.6 billion. But what Meta Platforms, and this is the former company known as Facebook, what you'll see here is that, oh, this is share-based compensation expense that's included in costs and expenses. So literally, if I add back this non-cash item up here to my net income, all of a sudden my profit's gone way up. And so I like the fact that Meta Platforms on the face of their financial statements, because it is extremely material, that they are going through and telling the investor, hey, these are, not only are we going to show it to you as an add back on the statement of cash flows, right? Not only are we going to show this to you right over here, we're also going to be coming over here and showing this to you on the face of the statement. Now notice over here, 6 months ended, the amount of the share-based compensation expense was $58.50. When we show our cash flows, we're showing it for the 6 months ended, and we see that $58.50 right over here. So again, when we see this amount, this is a very big number for Meta Platforms, and they have every absolute right to go through and to show it like this. And I frankly wish more companies would. Again, it depends how materially significant it is. So as we're looking at this over here, going back over here, taking a look at the cash flows, again, this can show us our net income and then our cash, but our real cash from operating activities was 26 billion. That's for the 6 months, right? Why? Because it was being dragged down by depreciation and, more importantly, share-based compensation. You see down over here, they used 11 billion in investing activities and then financing activities. One note here about a lot of students kind of sometimes will get like, dude, like, how do I remember financing, investing, and operating? Well, for financing activities, it's really if I'm buying or selling my own stock, right? If I repurchase shares, right? They repurchase 14 billion of their own shares, repurchase shares. If I sell shares, if I go through over here and basic buy or sell stock, if I buy or issue debt, buy back my own debt or issue it, investing, I'm purchasing property, plant, and equipment, purchasing, selling investments, acquisitions of businesses and intangible assets, and then pretty much everything else is going to go into operating activities. So, but again, if you're brand new to cash flows, right, if this is the first time you're going through and seeing it, I will include some links below for some different playlists for you to kind of go through and to take a look at. Just because I do really want to encourage you to really to go through and learn cash flows. One last thing that I want to say is that the amount of time you spend now learning and studying intermediate accounting will only pay off later, right? Because guess what? If you take the time to learn it now and spend the time on it now, when you come over here to this fun thing, which is a little thing that we go through and we call the CPA exam. By the way, I am trying to get Roger, my code for Roger, so I'm not just showing Becker. I had Roger live back in 91. It was pretty nice, 1891, 1991. Coming over here, like all the things that you're going to be going through and studying in terms of coming all these different parts over here, the more time you spend going through and learning in intermediate accounting, the easier it's going to be for you once you get to the CPA exam, right? All I can tell you is the more time you spend now, the easier it's going to be for you later, right? So over here, we've got the statement of cash flows. And again, it's on the exam. Spend the time on it now. And, you know, your intermediate accounting classes should be the worst class you take, right? We're all suffering because we're choosing to be accountants, but you're learning the skill and you have to put the time in. So in any event, and make sure that when you're going through and doing problems, don't just do it on Wiley Plus, Connect, or any of those things. Physically handwrite out the solutions. That's going to be the best way for you to really to go through and to learn the material. Okay, so thank you. I want to thank you for joining me here today. I just posted the chapter 3 and it's got a lot of views, so I'm gonna keep on doing them. So this is basically my lectures for intermediate accounting. And I want to thank you for joining me here today. If you have any questions, please feel free to email me at 1812cpa@gmail.com. And I look forward to seeing you on the next video. Have a great day.